silver, gold, and base metals. This is how to profit from net zero. So last week I did this video, Silver's Clean Energy Future, where I shared how I attended a investment conference with all the big fund managers and brokers and whatnot. And they were all presenting, and every single one of them was talking about ESG, rebuildable energy, all of that sort of stuff. However, there was one person who said, actually there's a debate about the realities around the science, but there's also the reality that there is not enough metals. In fact, there's not enough cobalt and other metals to produce enough EVs for the globe. So the economics of this don't add up, which is why it creates such an asymmetric play. And he said that we're going to see huge inflation by moving across to this stuff. Now, just came across my desk over the weekend was the HSBC's head of responsible investing. And he says he's fed up with the government demanding he waste time examining climate risks he knows are nonsensical exaggeration. They're an exaggeration, he says. And he doesn't pull any punches. So what I'm going to do, I'm going to share the whole video, goes for 15 minutes from this HSBC head of responsible investing, where he talks about this whole issue. And then what we'll do, we'll come back, we'll have a look at a piece that Chris Macintosh wrote over the weekend, and then we'll discuss how we can profit from net zero.
Hello, everyone. It's a pleasure to be here. Thank you very much, Andrew, back in the salmon bosom of the FT. It's a real pleasure. I miss the place horrendously. The 10 years at Lex and at the FT were the happiest of my professional career. So it's a real joy to be back. You probably don't expect a speech title like this at a conference like this. I do have a beard, which is my one sop to responsible investing. But I can happily say that I'm probably the only head of responsible investing worldwide at a major bank who has never used the word journey, either in print or up on stage. And I take a very, very financial and investment view of the topic. And it's only 20 minutes till coffee. And what I'm going to do over the next course of the 10 slides is to say why I completely disagree with the presentation that Sharon from Deloitte gave a couple of presentations ago, and why climate change is not a financial risk that we need to worry about. Heresy. I completely get that there is a competition for funding. I completely get that at the end of your central bank career, there are still many, many years to fill in. You've got to say something. You've got to fly around the world to conferences. You've got to out-hyperbole the next guy. But I feel like it's getting a little bit out of hand. The constant reminder that we are doomed, the constant reminder that within decades it's all over. And indeed, Sharon said, we are not going to survive. And indeed, no one ran from the room. In fact, most of you barely looked up from your mobile phones at the prospect of non-survival. It's become so hyperbolic that no one really knows how to get anyone's attention at all. Now, I wouldn't normally mind that. 25 years in the finance industry, there's always some nut job telling me about the end of the world. I've dealt with gold bugs my whole financial career. The roof's going to cave down. Y2K. Does anyone remember Y2K? Anyone old enough? The lifts didn't stop. But what bothers me about this one is the amount of work these people make me do. The amount of regulation coming down the pipes, the number of people in my team and at HSBC dealing with financial risk from climate change. Last night, Target fell 25%. 25%. And people are asking the board of US companies to spend time dealing with climate risk. I work at a bank that's being attacked by crypto, We've got regulators in the US trying to stop us. We've got the China problem. We've got a housing crisis looming. We've got interest rates going up. We've got inflation coming down the pipes, and I'm being told to spend time and time again looking at something that's going to happen in 20 or 30 years hence. The proportionality is completely out of whack. Now, interestingly, at the moment, markets agree, more or less, with me, despite the hyperbole, and this is a fun slide I put up just to annoy people. The more people say the world is going to end, and here I've looked at the number of incidences in all press around the world that use climate catastrophe, the number of times the phrase climate catastrophe is mentioned around the world, the higher and higher and higher risk assets go, in tandem. The more we're doomed, the higher prices go. How is that possible? So what's going on then? The Sharons and the Mark Carneys of this world need to tell us why prices are going up with our own demise. And there's really only three answers that are possible to old purists like me. Either the risk is negligible, which for investors is great. We get on with everything and fine, so no problem there. Maybe it's in the price. It's perfectly feasible that every single investor in the market, and there are millions of them, we all went to school and learnt about pricing theory, maybe it's in the price. In which case, if we solve climate risk, markets are gonna boom. And that's also fantastic for investors. Or the Mark Carneys of this world have to convince us all, including me, that every single one of us on climate risk is wrong. Every one of us. That's possible, but it's a big call to make. The first argument they often give is that it's going to hurt future growth. And we've all now seen the Kaya identity, and we're all talking about GDP, et cetera, et cetera. And a common argument, even used by the IPCC, is that it's going to hit GDP in year number, whatever it is, 2100. It's a long way away. They reckon it's going to lop off 2.5%. Their worst case models lops off 5%. What they fail to tell everybody, of course, is between now and 2100, economies are going to grow a lot. At about 2%, it's the red bar. At about 3%, it's the black bar. But the world is going to be between 500 or 1,000% richer. 1,000%. If you lop 5% off that in 2100, who cares? You will never notice. 2 years ago, GDP growth stopped. It was minus infinity. It was okay, mostly all right. Europe has a GDP per capita 40% lower than the US. Northern Europe, it's okay. 5% in the year 2100 is more or less irrelevant. But that wealth is important because adaptation is going to be a key reason why not only the financial implications are going to be de minimis, that the actual lifestyle implications will be de minimis as well. Most people put up the charts of hurricanes and floods and they go up. What they don't often put up are charts of the number of people who die from catastrophes, the amount of losses as a proportion of GDP or output. Anything where you actually put a denominator on those statistics tend to look like that. Human beings have been fantastic at adapting to change, adapting to climate emergencies, and we will continue to do so. Who cares if Miami is 6 meters underwater in 100 years? Amsterdam's been 6 meters underwater for ages, and that's a really nice place. We will cope with it. California's fire budget, and I don't doubt the science at all, there will be fires, but we do need to adapt. Their fire budget is only 1% of their state budget. It's 0.1% of their GDP. If economic growth continues how I expect it to grow, we can solve this through adaptation. And one of the tragedies of this whole debate, and which is what we obsess about at HSBC, is we spend way too much on mitigation financing and not enough on adaptation financing. And I'm sure most of you will agree with that. The other big problem that the Marks and Sharons have is this confusion between volume and value. And anyone who's run money or anyone's been an analyst knows this very well, but the climate community doesn't. There is a big difference between falling volumes and a falling price. Many things have to happen in between. Volumes can fall, revenues may fall, but that doesn't mean profits do. It doesn't mean cash flows do. We don't know how industries are going to respond. We don't know what companies are going to do with CapEx. We don't know what's going to happen with all the other things that affect companies in between those two things. What happens to absolute and relative prices at the end of this process is completely divorced from the transition winners and losers. My point being that there will be winners whose share prices or values go up and down. There'll be losers whose share prices go up and down. And what we do is we spend a lot of time looking at, these are pretty cool, right? It even looks like the HSBC logo. Did you get that? So these are volumes. So these are, coal companies, industrials, cement companies. They're going to see falling volumes. Of course they are. And there'll be sorts of companies that see rising volumes, renewables, all that sort of good technological stuff. But both of them, some will destroy value, some will create value, and it will depend on their capex, what they pay out. It will depend on all the things that we learned at university on what drives share prices. And it's very, very possible to build portfolios around both winners and losers. And we mustn't forget that at all. And we see that all the time. I've just pulled this up randomly. This is the global renewables index versus coal. And at the moment, coal is shooting the lights out. Renewables is having a bit of a wobble, and that'll reverse. And that's the way the world has been for hundreds of years. But don't tell me that renewables is going to outperform coal forever, because there'll be lots and lots of factors that change that dynamic. Another thing I often hear is, oh, what about stranded assets? And oh, my goodness gracious me. What matters is those stranded assets versus the value of the underlying business. Take something very simple like a PE. What happens when you buy something on 10 times that is not growing? All you analysts, you are basically getting your money back after 10 years of earnings per share, right? You are paying 10 years worth of earnings per share for a company. So let's imagine, for the sake of the argument, that is the earnings per share profile of your industry, and then Sharon is right, the world ends and the bars go deep red at the end. For most companies with stranded assets, and even for tech, their valuation does not take into account anything that happens after about year 20. At a big bank like ours, at HSBC, what do people think the average loan length is? It's 6 years. What happens to the planet in year 7 is actually irrelevant to our loan book. For coal, what happens in year 7 is more or less irrelevant. Now, the smarter ones among you will know for a growth company there's a terminal value and all of that sort of stuff. But in general, these sorts of companies aren't growing very fast. So the debate about what happens out here from a financial risk perspective, it's irrelevant. Don't care. Now, I completely agree with the panelists in the question in the survey before me up here about the one thing that I think could be a risk out of the blue. And I go back to those smiley faces. The one thing the market could get wrong is a whopping great carbon tax out of the blue, $200, wham, put that in your model. Okay, that is possible. But a lot of people smarter than me have already been starting to think about this, particularly central banks. Now, central banks are particularly annoying because they haven't spent enough time worrying about inflation and growth and why it's going out of control, and spent way too much time on climate risk. If you look at their publications, and I beg you to do this, Bank of England, particularly the Dutch, go right to the back in the small print when they do their climate stress tests, right to the back. They will put a whopping great policy shock into their model. And you go, oh, okay, that sounds a bit bad. Oh my goodness, that's going to wipe off. In fact, it's only going to wipe off about 5% of bank asset prices. But then you look at the sensitivities of what they've done. The first thing they do is they absolutely trash GDP growth. -1, -3, -3 again, that's never happened in my life. That's never happened ever. More fun is they do, and across all the scenarios, what they've done is a gigantic interest rate shock. All the Bank of England and central bank scenarios on climate risk to get a nasty number, they have given the financial sector a whopping great interest rate shock, and they never talk about it. It's all in the back of all the documents. You can read it. Very easy to make a bank look sick if you destroy their fixed income portfolio. And that's what they do. So even with a carbon tax, even hitting growth, they couldn't make climate risk move the needle. So they had to get their clever little wonks in the back room to put a gigantic interest rate shock through their models in order to make headlines. That is not reported very much either. But my final point, I guess, is an optimistic one. It's just before coffees. Everybody so far that I've listened to this morning has been quite doom-laden. Humans are spectacularly good at managing change. That is the long-run return of the S&P 500. That includes 2 world wars, that includes an oil crisis, that includes a financial crisis, that includes the pandemic. It goes up and up and up, and it will continue to rise at 6.5% real for as long as toast is toast, and the climate change won't change that either. Imagine you were in 1920 or 1930 or whenever this chart began, and we're at this conference and somebody said, Stuart, what do you think the effect on growth will be of carbon emissions over the next 100 years? And I'd get out my model, actually if I'd bring my team into the room and go, okay, well, there's a lot of gas-guzzling cars, there are a lot of ships, there's a lot of industry, that doesn't look very good, and we know that that goes into people's lungs. And we would put together a really, really nasty outlook for today from what we knew in 1930. We would never have understood the deindustrialization. We would never have understood the rise of the service economy. We would never understood how GDP is getting lighter. We would never understand how machinery is getting more efficient. Likewise, we do have no idea what the next 50, 100 years are going to bring, but I can promise you in 100 years when my great-great-grandson stands up and pulls up that chart, it will look more or less the same. The log pattern will hold. And all I do is beg people in this room not to be so negative around returns. The markets are crashing around our ears today and yesterday for nothing to do with climate whatsoever. I implore our leaders and our regulators most of all, because I spend way too much time at work dealing with this, to show some perspective. And let's get back to making money out of the transition, because there are thousands of opportunities out there. We have $1 trillion car company that nobody at the FT predicted 5 years ago, including myself. And they're the sort of opportunities we need to invest in all around the world. I agree in the just transition. I agree with the opportunities that exist in all these facets of technology, but it's a good thing. It's nothing to be ashamed or scared about. I rest my case. Enjoy your coffee. Thank you very much.
So also in this video, I talked about how this whole global cooling, global warming, climate change, this whole debate is something that I've been studying for more than 20 years. In fact, I've studied this longer than I've studied economics. And many of you asked for a whole bunch of resources, because I mentioned some scientists that I have followed and studied and read, and some of you asked for those resources. Now, I said to one person in the comments that you can download the IPCC reports and read them for yourselves rather than listening to what the media says is written in them, because it's very different to what they say. I also say to people you should download the anti-government panel on climate change. Read the book Mere Environmentalism by Stephen Hayward. Stephen Coonan, who was the former Undersecretary for Science in the Obama administration. Have a look at what he's been saying in some of his work. Former MIT professor Richard Linsden, he's got a lot of work out there. Alex Epstein, he's got a lot of work out there that I really like. Michael Schellenberger, he's got a book, Apocalypse Never, Why Environmental Alarmism Hurts Us All. And he used to be right in on the whole movement. So yeah, he's got some interesting things to say as well. And Elaine Dewar, she wrote a book called Cloak of Green, where once again she was all in on that movement. and she was writing about that whole movement back in the 90s and what she found. Seriously, read that book. If you can only read one book, read Elaine Dewar's Cloak of Green. Then I said, the best scientists that I recommend are Dr. Tim Ball, Ian Clark, Professor Peter Ridd, Professor Ian Plimer, Craig Idzo, Yuri Israel, who was the former vice chairman of the IPCC, Niels Axel Morner, who was Dr. Niels Axel Morner, he was the sole sea level expert on the IPCC, Dr. David Bellamy, Dr. Judith Curry, Dr. John Coleman, and then I mentioned a bunch of documentaries that you guys can watch as well that quotes a lot of these scientists that I mentioned. And even G. Edward Griffin's The Creature from Jekyll Island, even though it's a focus on central banking and the creation of the Fed, in that he talks about where this whole climate movement began and started. And remember, he wrote that book, late 80s, early 90s? And then I even said the World Economic Forum, download their A Partner in Shaping History, the first 40 years, 1971 to 2010. And in this manifesto, they themselves lay out their plans to use this whole climate thing to fulfill their Malthusian plans. So read their work. It's in their manifesto. They say it themselves. Don't believe me. Download it. Read it for yourselves. Now, one of those documentaries that I recommend is The Great Global Warming Swindle. I'll put a link in the description below. Once again, I highly recommend it. If you guys want to understand the science and just be open, have an open mind debate, I highly recommend watching this one. And then you've got Mark Morano, Climate Hustle. This is another good one that I highly recommend. Once again, a lot of the scientists that I quoted are in this documentary. Now, some of you may complain or say, well, hang on, Mark Morano, he's a right-winger, so of course he's going to say that. Fine, watch a proud socialist, a proud communist in Michael Moore in his documentary Planet of the Humans, where once again he exposes the scam, the fraud that it is. And in here he talks about, there's one key thing where he talks about how to make solar panels, to make windmills, you actually need a lot of coal, because to build steel you need a lot of coal. And anyway, he blames all this stuff on capitalism and says, well, this is all capitalism's fault. But really, let's be honest, there is no free market in this sector whatsoever. This is the biggest government intervention in any sector throughout the economy is in our energy sector. And in fact, the great Austrian economist Joseph Schumpeter warned back in the 40s, I think, 1946. Anyway, he warned that corporatism, or what we call cronyism, will be the death of capitalism. And that's what we've got. We've got corporatism, we've got cronyism, big business mixed with government enforcing these policies, which, there's no free markets. It'd be great if we actually tried free markets. But anyway, these are a few documentaries I recommend you watch. I'll put links in the description below. If you haven't watched them, please do so. And before we get into this article from Chris Macintosh that he wrote over the weekend, I just want to highly recommend you guys sign up to his free blog at capitalexploits.at. I'll put a link in the description below. Chris does some amazing work, and look, I've shared a video where I made $2 million on a coal stock, and I got to give a lot of credit to Chris for taking me into that whole coal and oil sector when it was unloved. No, I've just made huge returns, and I've got to put and give a lot of credit to Chris. He's done tremendous work in this whole energy sector, looking at the economics in this sector. And so just read his free blog. I'll put a link in the description. I just can't highly recommend it enough. So this is his article, The Net Zero Agenda Has Devastating Consequences. Here's what you need to know. Now, at the beginning of the article, he talks about this absolutist thinking and how this absolutist thinking means there's no room for debate on the other side. It's just, let's just shut the other side down so that we feel good, so that our ideas, are reinforced. And so this absolutist thinking is very dangerous, Chris discusses. So that's just the intro to where we're going with this piece. And then from facts and realities. Facts and realities are what typically bring societies back to some sense of rationality. Mao's China never gave up on attempting centralized farming because debate and discussion resulted in their thinking to themselves, my oh my, this doesn't look good. Perhaps we were wrong in our assumptions. No, they starved tens of millions of people first, and only when the evidence was absolutely overwhelming and the hysteria had burnt itself out, there was the ability to chart a different course. And this is where I'm bullish on uranium, because ultimately I think people will feel the pain of where we're going, and then they'll beg for nuclear. We've many examples throughout history, but let us today consider this one of CO2 emissions, which feeds into renewables, rebuildables I call it, and a sustainable future. Never in the history of man have we transitioned from a more dense energy form to a less dense one. The reason is simple. It is Bas Aquid. You guys get that. If we look at any time we've transitioned from a less energy dense form to a more energy dense one, we see a number of things. High productivity, lower inflation, the two go hand in hand, rising standards of living. It stands to reason that by doing the opposite, we're likely to see the following: lower productivity, increased inflation, and a falling standard of living. So energy return on investment, or EROI, get used to this acronym. Looked at purely from an investment perspective, an important ratio is energy return on investment, a multiple of your energy input that translates into output. Proponents of solar will point out that solar generates decent energy returns. What is often missed is that the numbers used to support this are more often than not cherry-picked from locations, enjoying sunlight and daytime hours. This is a problem given that solar doesn't work when the sun doesn't shine, which is on a cloudy or rainy day as well as at night. And this is a time when the bulk electricity demand comes into play to cover for the lack of solar energy. If a source generates electricity at a time inconsistent with demand, the price it can sell for can often be negative. It's like trying to sell me a cold cappuccino at 3 p.m. I don't want it. I want it hot and at 7 a.m. thanks. However, to get a true reflection of overall electricity costs, we need to factor in the storage and delivery costs to obtain the EROI. The future EROI will be lower than any preceding electricity EROI, and it will be due to more costly, less dense, and less effective energy sources. Then consequently, we can expect lower productivity, higher costs, higher inflation, and lower living standards. If we look at man's history from an energy perspective, we see the following: wood, biomass, coal, oil, natural gas, uranium. Biomass is denser in energy than wood, and coal denser still, and so on. Dense forms of energy with high EROI let nature do the work. For example, oil is just concentrated solar from eons ago. Now, infrastructure. Another issue that requires consideration is that solar and wind infrastructure require a lot of dense fuel to build, as I mentioned before. And in that Michael Moore documentary, he explains it well. Those wind turbines require a lot of steel. In order to produce steel, we need iron ore mines and coke and coal to form the steel. Then there is the concrete and the graphite. All of these things need to be mined, brought to the Earth's surface, trucked, shipped, forged, and so on. All of these processes are, if you think about it, components of energy density. But we're told by the absolutists that we're getting rid of all these processes. Zero is the absolute word. And in fact, if you guys remember at the climate jamboree in Madrid, when the UN General Secretary Antonio Guterres made a farcical statement saying we simply have to stop digging and drilling and take advantage of the vast possibilities offered by renewable energy and nature-based solutions. Well, the thing is, how does he think that wind turbines and solar panels are made by fairies? Like, does he not realize what they're made out of and what you need to do to make it? You know, you need around 220 tons of coal to make a wind turbine, and that's just a start. You know, you need so many more minerals and so much mining, and then for batteries as well. And so when he talked about nature-based solutions, what's he talking about? Chopping down trees and burning them? You know, these elites, these globalists, they're either fools or they're liars. And I think they're liars. I think they've got a greater motive, ulterior motive, and that statement's just delusional. It's an insult to every miner, and the policies he's calling for will absolutely cause untold hardship, poverty, suffering, and yes, even death. And we'll finish this piece that Chris wrote, Achieving Net Zero. We may well approach some level of zero in parts of the world. It will be zero energy, zero food, and zero life. And that means conflict of the sort we've never experienced in our lives. I wish it wasn't so, but that is the road we're on, with the absolutists steering this titanic catastrophe in the making. So how do we profit from all of this? Well, I can tell you right now that the economics do not add up. And the amount of metals and materials needed just aren't there. And so there is an asymmetric play here. Now, I believe we will get an energy crisis as we move across to this, which will lead to a food crisis and possibly even a monetary crisis. So from that point of view, gold and silver should do well, both on an inflationary basis and also on a crisis basis. And if you actually have a look at gold and many other currencies outside of the US dollar, gold's actually done really well. You know, you could invest in direct rebuildable companies, and I've certainly done that. And I currently hold a hydrogen company because a lot of these companies are likely to be bought out by the big boys, the Shells, the BPs, the BHPs, and that's exactly what happened to one of my holdings. Was, you know, Shell bought us out, and I just made an absolute killing on that. And you know, because they've got ESG requirements, they now need to say to the market, well, yeah, we've invested in this rebuildable technology and this company, and you know, we're doing our bit for the globe, and so there's going to be a lot of big boys taking over a lot of these companies. And currently, I have a hydrogen company which doesn't produce much energy, struggles storing it, and struggles transporting it because, well, it's hydrogen. However, thanks to taxpayers, we're getting a lot of funds. So thank you to the poor and middle class for your taxes. You're coming to me in this company that I own. So I really do appreciate it. Thank you. And ultimately, this will be bought out by a big firm. And whether they're able to find the technology to store the energy and to transport it safely, well, you know, that might happen. So that's an investment that I've got. Or you can actually invest in the mines that mine the metals that are needed. So I've shared this chart before. So just looking at EVs, the demand between now and 2030. So that's not too far away. There's going to be huge demand on nickel, aluminium, phosphorus, iron, copper, graphite, lithium, cobalt, manganese. Huge demand there. And I've got miners and explorers that are in exactly these metals. So even though I've studied the science around this and the economics of this, the politicians and the elites and now people believe in all this. So we're moving across to this, whether we like it or not. I'm just sharing you guys information and telling you the facts that you're not going to get anywhere else. And but you know, you can either profit from it or you can sit on the sidelines and just yell and scream and whatever. And I do the yelling and screaming, but I also profit from it. So a few other metals that I'd also add on top of that previous chart is I also like lead. I've invested in that. Silver will do very well, and zinc. So those three on top of the previous metals, so lead, silver, and zinc, I would add on to those other metals. So that there are a few ways that you can invest and profit from this, because it's estimated that it's going to be a $175 trillion investment needed to do this transition. And when you don't have the minerals and metals needed for that, so we're going to create all this huge demand and all this new currency, and it's going to be targeted towards this sector. So the inflation, the asymmetric opportunity is going to be huge. And for me, I will be profiting from it. So I hope you do too. Anyway, if you guys have got any other advice that you think are ways that you can profit from net zero, I'd love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut.